fundsupermart.com.
Can you briefly describe the US dollar bond fund's investment objectives and explain the strategy utilized? What do you look out for when selecting securities for the portfolio?
The strategy of the US dollar bond fund is to generate a combination of low risk income as well as capital gains for investors. The focus on the low income side of things is to invest in short dated corporate bonds. We find these bonds more attractive than short-dated US Treasury bonds, given the yield differential and given the high-quality nature of the companies that we invest in. At the longer end of the yield curve in the US, we find opportunities for capital gains, both in government bonds as well as in corporate bonds. For corporate bonds at the long end of the yield curve, we have to look for companies that have a margin of safety for investors. By that we mean they have to be reasonably bulletproof for economic downturns and reasonably bulletproof in terms of negative event risk for investors. The sorts of companies that we like are invested operating in sectors like US industrials, US pharmaceuticals and global food and beverage sectors, especially companies that have recently conducted a large mergers and acquisition transaction and have raised debt in the bond markets to pay for that acquisition. They have then subsequently focused their strategy on paying down debt, which is very beneficial for bondholders.
The fund has a large weight in US Treasuries. What are the reasons for this allocation, and can we hear your thoughts on the US Treasury yields?
Although yields in US Treasuries look low to many investors, based on the outlook that we have for growth and inflation in the US, as well as in many other developed markets, we think that the central bank policy function will remain very supportive of low yields for a long period of time. The Federal Reserve have already committed to keeping their QE program open well until unemployment rate reaches lower levels and that the economy is on a sustainable track to recovery. This means that this will happen for many years to come. The purchase program for buying mortgages and in a later stage Treasury bonds will keep Treasury interest rates at low levels. We think there's potential for yields to fall to even lower levels, and hence that's why we have a high weight in Treasury bonds. The focus on the Treasury bond side of things is long-dated Treasuries. Occasionally we also look to see if there are opportunities where yields in other markets are more attractive than US Treasuries. We offset this by taking out the currency risk using currency forwards. So for example, we can buy Canada bonds, German bunds, Australian bonds if we think there's better value there as a tactical trade relative to US Treasury bonds.
Are there other sectors that the fund is overweight on, and conversely, are there other sectors where the fund holds an underweight position?
The sectors that we like are based on the bottoms-up research process that we have at Fidelity. We have a strong team of analysts based in London and in the Asia region who focus on sectors on a global basis, up and down the capital structure, looking at both investment-grade companies and high-yield companies. As I mentioned earlier, the companies which exhibit the best margin of safety for investors at the moment are those who have conducted large mergers and acquisition transactions. They operate in sectors which are highly consolidated and have defensive properties such that they're able to generate strong cash flows even if the economy turns down. Examples of those include industrials in the US, pharmaceuticals, as well as the telecoms and cable sector in the US. Sectors that we do not like are ones who are very exposed to a potential global slowdown. We are seeing signs of a slowdown in many emerging markets, and so those companies include sectors such as metals and mining, commodity sector, as well as companies that perform poorly when interest rates are low, such as insurance companies who generate smaller profit margins and are more exposed to shifts in the interest rate environment. And then more generally as well, we find that emerging market debt is relatively expensive, and given the risks that emerging markets and global markets face generally, we think that it's prudent to be low in weight in emerging markets.
How does the US dollar bond fund fit into an investor's portfolio then?
There are a range of bond funds that have very different correlations to traditional equity market funds and stock funds in general. The higher risk bond funds, such as high yield funds, tend to have a very high correlation with equity funds and with the equity market in general. The advantage of the US dollar bond fund is that it has a negative correlation with the equity market over different economic cycles. such that investors get a combination of income and capital gain and diversity relative to stock market performance. And this is because the fund is low risk in nature, has a high weight to long dated bonds, has a high weight to high quality corporate bonds which perform well in both a strong economic environment and a weak economic environment.